Imagine you wake up, check the news, and the bank holding your money has failed. Overnight, the doors are locked, the headlines are screaming, and somewhere inside that building is your paycheck, your rent money, your savings. What actually happens to your money? The answer is not what most people fear, and it's genuinely reassuring once you understand the machinery. In the United States, in the overwhelming majority of cases, you don't lose a cent, and you often have access to your money again within a single business day. Not weeks, not a court battle, a day. But there's a catch, a specific limit and a specific mistake that can turn perfectly safe into you lost money. Most people have never checked whether they're on the safe side of that line. So today I'll walk you through exactly what happens when a bank collapses, step by step, why your money is almost certainly fine, and the one thing you need to check tonight to be completely sure. No panic, just the mechanics nobody explains until it's too late. I'm Mr. Finance. I take the scary money questions and replace the fear with how it actually works. If that's your kind of thing, subscribing takes one tap. Now, where does your money actually go? To understand a bank collapse, you first have to understand something most people never think about. Your money isn't sitting in the bank waiting for you. When you deposit $1,000, the bank doesn't put it in a labeled drawer with your name on it. It lends most of it out to someone buying a house, a business getting a loan, a car being financed. The bank keeps only a fraction on hand because on any normal day, only a few people withdraw at once. This is how banks make money. They pay you little or nothing on your deposit and charge borrowers interest on it. The gap is their profit. This system works beautifully right up until it doesn't. It relies on a simple assumption. Not everyone asks for their money back at the same time. On a normal day, that's true. But if enough people get scared at once and all rush to withdraw, a bank run, the bank can't return everyone's money simultaneously because most of it is out in the world as loans that can't be called back instantly. Even a healthy bank can be knocked over by pure panic. That's the fragile heart of banking. It runs on trust, and trust can evaporate faster than loans can be repaid. So a bank collapse usually isn't cartoon villains stealing a vault. It's this. The bank made bad loans or lost money on investments. People got nervous. Everyone tried to withdraw at once, and the bank simply ran out of available cash to hand back. The doors close. And that's the exact moment the safety net snaps into place, which is where your money's fate is actually decided. Here's the part that turns terror into a shrug. In the United States, deposits at almost every bank are protected by something called FDIC insurance. FDIC stands for the Federal Deposit Insurance Corporation, a government agency created after the Great Depression, precisely because back then, when banks failed, ordinary people really did lose everything. The country decided never again. Here's how it works. If your bank is FDIC insured, and virtually every legitimate U.S. bank is, the government guarantees your deposits up to $250,000 per depositor, per bank. That means if your insured bank collapses tomorrow with your money inside, the government makes you whole, up to that limit. Not maybe, not eventually, after a lawsuit. It is a legal guarantee, and it has never failed to pay an insured depositor in the agency's entire history. And it's fast. When an insured bank fails, the typical playbook is that another healthy bank quietly takes over the accounts, often over a single weekend. You wake up Monday, and your money is simply at a new bank, same balance, same access, sometimes without any interruption at all. In the cases where that doesn't happen, the FDIC pays insured depositors directly, usually within a couple of business days. The dramatic image of losing everything overnight is, for an insured depositor under the limit, essentially fiction in modern America. This is why, during real bank failures in recent years, insured depositors barely felt it. The headlines were dramatic. The actual experience for ordinary customers under the limit was closer to boring. The system was built specifically so that a bank's collapse is the bank's problem, not yours. That umbrella is the single most important thing to understand about your money's safety. And it's free. You don't sign up. It's automatic at any insured bank. Now the catch, because I promised you honesty, that guarantee has a limit, $250,000 per depositor, per bank. Money above that line, at a single bank in a single ownership, is not automatically protected. If a bank fails and you had $400,000 sitting in one account there, the first $250,000 is guaranteed, and the rest becomes uncertain. You might recover some of it over time as the bank's assets are sold off, but it's no longer a sure thing. For most people, this never matters. Most of us don't keep $250,000 in a single checking account. But if you ever do hold large sums, after selling a house, an inheritance, a business sale, this line suddenly matters enormously. And the fix is almost insultingly simple. The fix: spread money across multiple banks so no single bank holds more than the insured limit. 250,000 at one bank, 250,000 at another. Now the full $500,000 is covered because the limit is per bank. There are also ways to increase coverage at a single bank through different account ownership types like joint accounts, which each get their own limit. But the simplest rule to remember is the cleanest. Don't keep more than the insured limit in any one bank, and you are completely protected no matter what happens. This is the one thing to check tonight. Not because your bank is about to fail, it almost certainly isn't, but because being under the limit costs you nothing and removes the risk entirely. It's the rare situation where perfect safety is free and takes 5 minutes to arrange. The people who lost money in bank failures were almost always the ones sitting above the line, who assumed it would never happen to them. Here's a distinction that trips up even careful people, and it's genuinely important. FDIC insurance covers deposits, checking accounts, savings accounts, money market deposit accounts, and certificates of deposit. It does not cover investments, even if you bought them through the same bank. So if you bought stocks, bonds, mutual funds, or an index fund through your bank's investment arm, those are not protected by FDIC insurance because they were never deposits. They can rise and fall in value, and that risk is normal and expected. FDIC exists to guarantee the money you handed the bank for safekeeping, not the investments you chose to take a risk on. Mixing these two up is how someone can wrongly believe everything at my bank is insured. Now, there's a separate related protection for investment accounts called SEEP-C, which protects you if your brokerage firm itself fails and your shares go missing, up to its own limits. But, and this is the key honesty anchor, SIPC does not protect you from your investments simply losing value. If your index fund drops 30% in a crash, no insurance covers that, nor should it. That's the ordinary risk of investing, and it's the price of the growth investments offer over time. So hold two clear ideas. Your deposits at an insured bank are guaranteed up to the limit, genuinely safe, even in a collapse. Your investments are not guaranteed against losing value, and never will be, because their whole purpose is to take on risk for the chance of growth. Knowing which of your money is which is the difference between real understanding and false comfort. It's worth understanding where this umbrella came from, because the story is exactly why you can be calm today. Back in the early 1930s, during the Great Depression, the United States had no deposit insurance. When a bank failed, the people who had trusted it with their savings simply lost the money, gone. And because there was no safety net, the moment one bank wobbled, terrified customers at every other bank rushed to pull their cash out too, which caused perfectly healthy banks to collapse from the panic alone. Thousands of banks failed. Millions of ordinary families lost their life savings, not because they did anything wrong, but because fear fed on itself with nothing to stop it. The country looked at that catastrophe and drew a hard lesson. A banking system built purely on trust will always be one bad rumor away from collapse. So in 1933, it created the FDIC, the government guarantee you now have. The genius of it wasn't just paying people back after a failure. It was that, once people knew their money was guaranteed, they stopped panicking in the first place. The runs largely stopped. The insurance didn't just cover the damage, it prevented most of it, because a depositor who knows they're protected has no reason to join a stampede. That's the quiet brilliance of the system you're standing inside. Every time you don't panic about your bank, you're benefiting from a lesson paid for by people who lost everything 90 years ago. The umbrella over your money exists because a generation got soaked without one, and understanding that history is exactly what lets you stay dry and calm while others reach for their raincoats. So after all this, should you actually worry about your bank collapsing? The honest answer, almost certainly not. And panicking is its own risk. For the ordinary person keeping normal amounts in an FDIC-insured bank, a bank collapse is close to a non-event. Your money is guaranteed, the transition is usually seamless, and the entire system was engineered so that a failing bank is not your problem. The people who yank all their cash out and stuff it under a mattress in a panic often create a bigger risk for themselves. Cash at home earns nothing, quietly loses value to inflation, and can be lost, stolen, or destroyed with no insurance at all. The mattress is far more dangerous than the insured bank. What a smart person does instead is boring and effective. Keep your money in a reputable FDIC-insured bank. Make sure you're under the insured limit at any single one. Understand that deposits are guaranteed and investments are not, and then simply stop worrying about it. The fear of banks collapsing is loud. The reality, for an insured depositor, is that the system quietly does exactly what it was built to do. Understanding removes the fear. That's the whole point of this video, not to scare you about collapses, but to hand you the calm that comes from actually knowing how your money is protected. A bank run is powered by panic. The person who understands the machinery is the one who doesn't join it. So what happens to your money when a bank collapses? Your deposit was never in a drawer, it was lent out, which is why panic can topple even a healthy bank. But in the US, FDIC insurance guarantees your deposits up to $250,000 per bank, usually restoring access within a day or over a weekend. Above that line, you're exposed, so spread large sums across banks. And remember, deposits are guaranteed while investments are not. That's not a flaw, it's the deal. Stay insured, stay under the limit, know which money is which, and a bank collapse goes from a nightmare to a headline you can watch calmly while your money sits safely exactly where it should. A collapsing bank sounds like the end of your money. For an insured depositor under the limit, it's closer to a paperwork shuffle you barely notice. The system was built after real people lost everything, specifically so it could never happen that way again, and in its entire history, it has never failed to pay an insured depositor. I won't pretend risk doesn't exist. Money above the limit is genuinely exposed, and investments can always lose value. But both of those are things you can see clearly and manage in an evening. The scary version of this story only happens to people who never learned the mechanics. Now you have. I'm Mr. Finance. Subscribe if you want more of this. Fear replaced with how it actually works. No hype. And tell me in the comments, before this video, did you think you'd lose your money if your bank collapsed? And are you going to check tonight whether you're under the insured limit? I read every single one.